Hello and welcome to the week ahead from the Financial Times in London. Here are some of the top stories we're watching in the coming days. Political manoeuvrings abound as the Chinese Communist Party holds its annual plenum. All eyes will be on Apple's chief executive Tim Cook as the company reports its third quarter results. And Sweden's central bank, one of the pioneers of negative rates, will announce whether it will dig deeper into negative territory. But first, the year ahead promises to be a testing time for Chinese President Xi Jinping, and it all begins next week when his ruling Chinese Communist Party holds its annual plenum, the last before 2017's all-important party congress. Although he's expected to be appointed to his traditional second term as head of the party at the Congress, almost all other party positions are in play. It'll be in the president's interest to surmount a strong base of supporters within the party if he wants to influence politics after he stands down. If he fails to position the right people and cement his legacy, the question is whether he might attempt to bid for a third term as president, which would break an unwritten tradition in Chinese politics. And as our Deputy Beijing Bureau Chief, Lucy Hornby, explains, he's going to have his work cut out for him.
He's had a sometimes vicious, sometimes well-received anti-corruption campaign that effectively has knocked the legs out of some of the other factions in the government. But what he lacks is a base of people built up over a long career that are loyal to him. And to a certain degree, if you're the most powerful person in the room and you determined who goes into a position, you don't have to worry about 3 decades of loyalty. But those 3 decades of loyalty and of having worked together with people are the glue that really holds in the Chinese system. And he's proving to be unusually weak in that. So what he needs to do is try to get his people in position, either by pulling up people he's worked with before or by creating new loyalties through rewarding people with positions.
It'll be a big week for Silicon Valley. A slew of tech earnings are expected, including Google's Alphabet, Amazon, Twitter and Apple. Last quarter, Apple said they'd reached a turning point after iPhone sales had shown a decline. The company's stock price, which has been up 25% in the last 3 months, would seem to reflect such assertions. For the quarter that ended in September, iPhone sales are expected to be slightly under the 48 million that Apple reported this time last year, somewhere nearer 45 million. Nevertheless, investors are looking forward to next year. Wall Street expects iPhone sales to return to growth, so CEO Tim Cook's guidance will be closely watched to see if it mirrors that expectation. This comes after concerns were raised when the company refused to release opening weekend sale figures for the iPhone 7, something it's done for years. The FT's Tim Bradshaw has more.
Last week also saw the arrival of a new rival to the iPhone, Google's Pixel smartphone, and costs from that, along with Google's other big initiative in the cloud this year, has seen costs at Alphabet go up. Investors have been happy to go along with that recently because Google's advertising business has been on fire thanks to mobile search and YouTube, and these trends are expected to continue when Alphabet releases its earnings on Thursday. Thursday is likely to be a less happy day for Twitter, which is also reporting its numbers. Shareholders always keep a close eye on its monthly active user figure, which at about 313 million has been falling behind new arrivals such as Instagram. But those numbers will likely take second place to speculation about a Twitter takeover. Its shares were up recently on the back of hopes of a deal with Google, Disney or Salesforce. All those acquirers now seem to have melted away, and Twitter had already lowered its revenue expectations 3 months ago, so investors will be really looking for any sign there is still hope of a deal.
And finally, the world's oldest central bank meets this week to decide whether to deepen the newest of monetary policy experiments. Sweden's Riksbank has been one of the pioneers of negative rates, and its actions will be watched by policymakers from the Eurozone to Japan, all of whom are grappling with their own versions of negative rates. On Thursday, it will announce whether it will cut rates again from their current record low of minus 0.5%. A falling krona isn't helping the situation, but critics argue that negative rates have exasperated an already hot property market and stoked household debt levels. They've also highlighted the oddity of a central bank cutting rates while the Swedish economy recorded growth of 4.2% last year. But growth is expected to slow in the coming years, especially as immigration numbers fall sharply from their record high in 2015.
The Riksbank is on the horns of a very tricky dilemma. They're already afraid at the current minus 0.5% that negative rates are fueling future problems in the housing market and with household debt. But at the same time, their main target is to get inflation to 2%. And while in 2014-2015 inflation was slowly ticking up, this year it's been falling pretty much consistently. And that's why many in the markets think that a rate cut is likely.
And that's what the week ahead looks like from the Financial Times in London. See you again next time.